We have something we call the SUN initiative. SUN stands for Stabilizing Urban Neighborhoods. And what it is, I'm a little bit sad to say, it's still the only initiative in the country that is actually keeping homeowners in default or foreclosure in their homes. And these are primarily low-income folks who ran into trouble during the foreclosure crisis, which, although it's over for many middle-income and upper-middle-income communities, unfortunately is not over for many urban and lower-income communities. And so, we had this notion that, in fact, if people were properly underwritten, that they would go back to being good homeowners and good borrowers, just like they had always been before, no-doc loans and lots of loans around that people couldn't afford from the get-go. We went out to the markets and they said, oh, if there were money around for this at all, it'd probably be at 12%. Well, our plan was to lend at just over 6, and maybe you guys know how to borrow at 12 and lend at 6, but I missed that class in law school. So we had this big problem, and when you really sort of dug into it and said, why is it that for mortgage finance we're going to be somewhere north of 12%? The answer, of course, was risk and risk assessment, and everybody we talked to said, those people who are poor, low-income, urban, often people of color, like by about 80% maybe, generally new immigrants, are not going to pay their mortgages. Everybody knows that they already haven't been paying their mortgages. We had a very different view of this, of course. What we thought was the failure to pay mortgages had to do with the fact that people had mortgages that were not payable. I sometimes say my favorite or least favorite example of this was the hairdresser who came to see us, who made $23,000 a year. She had a mortgage of $325,000, right? And you sort of look at that and you say, she could have decided not to eat, not to heat her home, not to feed her kids. She still wouldn't have been able to pay her mortgage. So from our perspective, there was lots of responsibility to go around. We didn't think that the blame and therefore the risk on that really needed to be with individuals. For a few years, I'm pleased to report that we actually have been able to reduce both outstanding principal amount and monthly mortgage expense, monthly housing expense for the folks in our initiative by about 40%. So essentially what happens is you take a $3,000 monthly payment, you reduce it to $1,600. Oddly enough, people can pay it.